Imagine this. You've just hit your personal best at the gym, and the next day, instead of celebrating, you feel exhausted and sore. That's exactly what happened to the US stock market today. After the S&P 500 smashed record highs for 2 days in a row, the market suddenly slowed down and the Dow Jones slipped. The reason? A hotter than expected inflation report. Hello and welcome back to Today in Finance. In this video, we'll break down why Dow Jones and other major indexes dipped during early trading even after such an incredible winning streak. We'll also talk about what Producer Price Index really is and what it means for your money, why inflation numbers spooked Wall Street this morning, and what does that mean for interest rates, your economy, your investments, and so many other things. So without wasting any time, let's get straight into today's video. The S&P 500 had been on an incredible run, closing at record highs for 2 straight days. Technology stocks were leading the rally, optimism was high, and traders were feeling very confident. But the stock market is like a tightrope. When you've climbed high, it doesn't take much to shake your balance. This morning, that shake came in the form of a surprising inflation report, reminding everyone that the fight against rising prices isn't over just yet. The Producer Price Index, or PPI, measures how much prices are changing of goods and services before they reach final consumers. Think of it like checking the price of raw ingredients before they get turned into a meal at a restaurant. If those ingredients cost more, chances are that the final price of the meal will also go up. In an economy, when producer prices rise, it's often a warning that consumer prices and inflation could follow soon. This latest PPI reading came in hotter than economists predicted, meaning production costs are climbing faster than expected. That's a red flag for investors because it can signal that inflation is heating up again. When inflation rises, the Federal Reserve may feel pressure to keep interest rates high to cool the economy. Higher interest rates make borrowing more expensive, which can slow down spending, investment, and ultimately stock market growth. The moment the numbers came out, traders began to sell, pushing the Dow Jones lower in early trading. When markets are at record highs, even a small piece of bad news can cause a wave of selling. After such a strong run, traders were already looking for a way to take profits, and the PPI report gave them that reason. While the drop wasn't a huge crash, it was a signal that investors are sensitive to inflation data and the possibility of prolonged higher interest rates. The Federal Reserve plays a central role here. Its job is to keep inflation in check without damaging the economy, and it mainly does that by adjusting interest rates. So when inflation shows sign of sticking around, the FED might decide to delay cutting rates or even consider raising them again. Wall Street has been hoping for rate cuts to stimulate growth, so the idea of higher for longer is not what traders want to hear. This is the reason why this hot inflation report suddenly changed the mood in the market. By late morning, the Dow was in the red, with the S&P 500 and Nasdaq also showing weakness. The reaction wasn't panic-driven, but more like the market catching its breath after a sprint. Some traders stepped aside to wait for more clarity, while others saw the dip as a small buying opportunity. Overall, the tone was cautious, with investors weighing whether this was just a temporary pullback or the start of a bigger slowdown. Different sectors felt the impact in different ways. Interest rate-sensitive areas like real estate and utilities slipped as higher rates threatened to squeeze profits. Technology stocks, which had been leading the rally, delivered mixed results as some investors locked in gains while others held on. Banks, however, showed some strength, benefiting from higher interest rates through increased lending margins. This mixed performance highlighted that inflation data doesn't affect all parts of the market in the same way. Next inflation reports. Investors will be paying close attention to the next consumer price index and PPI readings. If both reports also come in hot, it would confirm that inflation is stubbornly sticking around. That would likely increase expectations that the FED will delay interest rate cuts. Federal Reserve speeches. In the coming weeks, several FED officials are scheduled to speak publicly. Traders will listen closely for hints about whether the central bank still sees inflation as under control or if they believe stronger action is needed. Even small changes in tone can move the market significantly. Earnings season. Corporate earnings report will reveal how companies are handling rising costs. If businesses are still managing to grow profits despite higher prices, it could ease some inflation concerns. But if earnings show weakness, investors might turn more cautious. Bond market reaction. The bond market often reacts faster than stocks to inflation news. If bond yields start rising again, it could put pressure on stocks, especially growth-oriented companies. Traders will be watching for any sharp moves in yields as a signal of shifting expectations. If you are a long-term investor, today's drop should not send you into panic mode. Markets naturally move up and down, and one inflation report is just a single data point. Instead of making any rash decisions, keep your investments diversified, stay informed of key economic reports, and focus on your long-term goals. Short-term noise may be unsettling, but always remember that successful investing is all about staying the course through good and bad days. With that being said, this is all from my side for today. I hope you found this video helpful, and if you do, make sure to give it a big thumbs up and subscribe to my channel for more financial insights. I'll see you tomorrow with another one. Until then, stay tuned.